Angel tax and investment in startups. So this has been a point of a concern of various issues as to whether still angel tax is somewhere a hindrance for investing in startup, and whether startups are still fully exempt or there are still some concerns involved. So just thought to have a session specifically on this practical issues, so that there has to be an understanding as to how angel tax was brought in, and how exemptions for startups were given. But still, yes, there are some concerns as well on the operational part. So let's get started, friends. Before starting, would like to acknowledge the effort of Harsha for preparing this presentation. The legends used in the presentation: AIF, Alternative Investment Fund; AO, Assessing Officer; Date of Incorporation, DOI; DPIIT, erstwhile DIPP, that is Department for Promotion of Industry and Internal Trade; FMV, Fair Market Value; FV, Face Value; Financial Year, FY; IFRS, Income from Other Sources; IMB, Interministerial Board; MB, Merchant Banker; MSME, Micro, Small and Medium Enterprises; NW stands for net worth; PUSC, paid up share capital; SP, securities premium; and VC, venture capital. So the schema for the evening: what is the angel tax? A brief understanding about what it is. Exemptions: what are the various exemptions available from angel tax? One such exemption is for startup. What is a startup? When is startup exempt from angel tax? Consequence of non-compliance. There are some conditions which are prescribed for startup to get exemptions from angel tax. What will happen if if there is breach of any of the conditions? The caveats. This is what is more important, friends. Still, what are the concerns or caveats when it comes to angel tax and investing in startup, and the way forward? So, prima facie, what is angel tax? Angel tax again refers to section 5627B of the Income Tax Act. It is an income tax payable on capital raised by unlisted companies via issue of shares, where the share price is seen in excess of FMV of the share sold, resulting in an effective tax of over 30%. So now let's decipher each and every component of angel tax. Who is the recipient? Recipient being a private limited company receiving consideration for issue of shares, receiving from resident. So non-resident are excluded from the purview of angel tax. Conditions: issue price should be more than face value of shares. That is, it has to be issued at premium, and so it's not an or condition, friends. And consideration is more than the fair market value. The aggregate consideration more than the fair market value of shares. What would be taxable in the hands of company? The whatever amount, it would be charged as income from other sources. It would be calculated as total consideration minus aggregate fair market value of shares such issued. So this is what is the angel tax, friends. Now, what are the exemptions available? Like where this 5627B shall not be applicable, where the consideration for issue of shares is received by a venture capital undertaking from a venture capital company or a venture capital fund or a specified fund. What exactly is specified fund, friends? Fund established or incorporated in India, which has been granted a certificate of registration as a category 1 or category 2 AIF and is regulated by SEBI. One more exemption has been provided by so consideration for issue of shares received by a company from a class of persons as may be notified by the central government. Central government has notified the startups recognized by DPIIT as class of persons. So from whom, if that company is receiving such a consideration for issue of shares from resident, angel tax would not be applicable. What is a startup? So let's now understand the exact meaning of startup. Startup. This was by virtue of a notification which was issued by the central government while notifying startup as a class of person. Startup, an entity shall be recognized as a startup up to a period of 10 years from the date of incorporation or registration if the following three conditions are satisfied. It is registered or incorporated in India either as a private limited company, registered partnership firm, or a limited liability partnership. Turnover of the entity for any of the financial years since incorporation or registration is less than or equal to 100 crores. Entity is working towards innovation, development, or improvement of products or processes or services, or it is a scalable business with a high potential of employment generation or wealth creation. An entity formed by splitting up reconstruction of an existing business shall not be considered a startup. So, friends, this was the definition given in the notification. So, the only change here, I mean, this definition differs slightly from section 80 ISC. In 80 ISC, registered partnership firm is not being considered. So only private limited company or limited liability partnership is being considered. Secondly, the definition of, the engagement of activities, that is more or less similar. Again, the criteria of splitting up or reconstruction or of an existing business also seems to be similar or in line with section 80 IAC startup. Then when that exemption would be available, there are conditions. There are two conditions, friends. First condition being aggregate amount of paid up share capital is and the share premium of the startup after issue or proposed issue of share should be less than or equal to 25 crores. So this is one condition. While calculating the limit of 25 crores, amount received from non-resident VC company or VC fund or specified company. Specified company meaning listed company whose net worth on the last day of the financial year preceding the financial year in which shares are issued is greater than 100 crores, or turnover for the financial year preceding the year in which shares are issued is more than 250 crores. So if amount is being, the criteria of 25 crores, while calculating that criteria, amount whatever received by non-resident or VC company or VC fund or such specified company, that would be ignored for the purpose of calculating 25 crores limit. Second condition: a startup should not invest in the following, or it can invest in the should not invest in the following, or cannot invest in the following for a period of 7 years from the end of latest financial year in which shares are issued at a premium. So up to 7 years, these investments are not allowed, friends. These conditions or these restrictions are I would not say draconian, but yes, to an extent difficult for any company to adhere to. Building or land appurtenant thereto being a residential loss, other than that used for the purpose of renting or being held as a stock in trade in the ordinary course of business. Land or building or boat not being a residential house, other than held for the purpose of plying, hiring, leasing, or stock in trade in the ordinary course of business. Loans in advance, other than lent in the ordinary course of business, where lending is a substantial part of business. So any loans in advance given by a startup within 7 years, when such shares were issued at a premium, that would be regarded as a violation, and exemption shall not be allowed. Capital contribution made to any other entity, investment made in shares and securities, a motor vehicle, aircraft, yacht, or any other mode of transport whose actual cost is more than 10 lakh rupees, other than that which has been held for the purpose of plying, hiring, leasing, or stock in trade in the ordinary course of business. Jewelry other than held as a stock in trade. Other assets like the archaeological collections, painting, drawing, sculpture, or any other work of art or bullion. So these investments are not allowed for a startup. If done, the exemption which was available would be revoked, and so that's what here the non-compliance. In case there is non-compliance, the consideration show received in excess of FMB will be deemed to be income of that company, taxable in the year of such failure has taken place. So whenever there is a failure, there would be taxability, and more importantly, it would be regarded as underreporting of income, whereby again 200% penalty of the tax payable amount of the on the underreported income shall be levied. So that income which was, or rather the amount consideration, like consideration minus FMV, the income from other sources which was any which was taxable under 5627B, that would get invoked in case there are non-compliance. Along with that, there will be penalty of 200% of tax payable on the underreported income. So this shall be regarded as underreporting of income. Then, friends, the caveats. So now, what are the concerns still involved? So there are there is an angel tax, there is exemption available for the purpose of startup. There are some conditions, but still there are some concerns, some caveats for startups. Startups that invest in shares and securities are not eligible for angel tax exemption, as we have seen. Since most new ventures tend to invest in debt mutual funds to multiply their fund, this hinders their growth. A blanket restriction on investment in shares and security impairs the ability of startup to expand its operation through acquisitions or setting up subsidiaries. So this for a startup becomes paramount, because they tend to multiply their capital by investing in various debt mutual funds. So if this is a restriction provided to these startups, they may not be in a position to scale up their business. The second caveat here in the embargo on the downstream investment as well as loans and advances are far too constraining. So, say for example, if a startup is giving as a loan to its employees as well, that would be regarded as loans in advance given, and that would form part of a restriction, and accordingly the exemption shall not be available. So certainly there is a requirement to revisit this end users limit. Section 68, which relates to unexplained credits. So section 68 talks about whenever there is credit into anyone's account and there is no justification being provided, and the assessing officer is of the view that there contains some misreporting or underreporting, he can invoke section 68, and if there is no genuineness being established, or no creditworthiness of the sum which is being received, he can levy tax on that. He can consider that as an income and levy tax on that. Under the section, it provides relief only for VCC or VCF in terms of share capital money received. So in case the amount has been received as a share capital or a share application money, that as well forms part of the section 68 unexplained credits. But VCC or VCA, that is venture capital company or venture capital fund, are exempt from such. So if venture capital company or VCF are receiving share capital money or share application money, section 68 cannot be invoked because an outright exemption has been provided in that section. But here again, friends, startups are not included. So in case if a premium is being received by a startup company, even though 5627B may not be applicable, but under section 68, the officer may ask the startup company, and it may go to a level even to ask the resident who has given that money, or who has received that shares at premium, to provide proper justification of nature and source of such sum invested. So a level can be taken above, and even the assessing office can ask the resident as to what is the source and nature of income or amount which he has received, by virtue of which he has invested in the startup company. So this seems to be far stretching, friends. Fourth concern, again, startups are barred from making a capital contribution to any entity. This again creates obstacles for companies that operate in certain sector that requires license with other firms to sustain long-term growth. So again, there is no synergy being created, and if this is disallowed, at least you will see in the way forward, we have suggested that at least capital contribution in a startup entity. So a startup, eligible startup investing in a eligible capital of eligible startup company. If that as well is allowed, maybe there can be synergy, and it can sustain, both the firms can sustain long-term growth. But this being a concern, certainly there is a requirement of revisit here. Lastly, the startups may now be forced to raise funds over the permissible limit of 25 crores by way of debt. So up to 25 crores, as we have seen that criteria, they can raise equity. But more than that, again, they have to resort to means of debt. Again, debt on that comes along with an interest payment, so that might hinder or that might affect the profitability, especially for a startup where, like, initially it would there would be a lot of gestation period, and there will not be much of profitability in such scenario as well. They have to face the interest burden because they've raised funds from or excess funds from debt. So these were the concerns, friends. The way forward, again, as I said, the end use test needs to be revamped. There has to be some leniency, as mentioned before. Eligible startups investing in another eligible startup should be permitted. Upon non-compliance, the receipt of share capital money by startup shall be regarded as income, and tax shall be payable. However, the section further considers this as underreporting, and 200% penalty is required to be paid, friends. So this nowhere seems to be logical as well as reasonable. Yes, you consider that amount being received as income, to that extent it's fine. But again, considering that as an underreporting of income and charging 200% penalty seems to be a bit slightly illogical and unreasonable, especially from the startup's perspective. Again, if not 5627B, there is always a hanging sword of section 68, because startups are not exempt from section 68 while they receive a high premium on issue of shares. Only DPIIT recognized startups have been spared from intellect, but MSMEs and SMEs, again operating on a similar segment of innovation, development, and employment in rural areas, may not have bandwidth to even go for or to complete the registration and documentation process. which is recognized. It's an online thing, friends, to get an exemption under startup. So that being the case, if MSMEs and SMEs are operating in similar space in rural areas, may not be competent enough to complete the documentation and registration process. This may be again a hindrance, and angel tax may be charged to them as well. So these were some of our thoughts, friends. Like yes, prima facie it looks like yes, angel tax has been relaxed for the for startups, but yeah, there are still some concerns, some caveats wherein the there won't be a full respite given to startup, as we have seen section 68 and other end use criterias or restrictions on end use, which is bothered which would bother startups a lot. So these were some of our thoughts, friends. Any questions, would be happy to answer, friends. Thank you, friends.